Welcome. Today we begin a clear step-by-step tour of the stock market. You have seen headlines and felt the noise. This course will cut through that confusion. We will cover what a stock is, primary versus secondary markets, how prices move, and the role of SEBI and exchanges. This is a teaching module. Listen, pause, take notes, and you will understand. Think of the stock market as a giant marketplace. But instead of fruit, people buy pieces of companies. Ready? Let's begin with the single most important question. What is a stock? Chapter 1. What is a stock and how does it work? The title stays on screen while we explain. Stay with me. We will move from concept to real-world examples in the next section. What is a stock, exactly? The title is on screen. Now the definition. A stock represents ownership. A share is a small piece of a company. Think of a company as a pizza. Each share is a slice. Buy a slice, you own part of the pizza. If there are 1 million shares and you own one, you own 1/1,000,000th of the company. Shareholders have claims on company assets and potential future profits. A dividend is a company paying part of profits to shareholders, a cash reward for ownership. Companies sell shares to raise capital for growth, build, hire, research, expand. The first time they sell shares to the public is the IPO, which we'll cover next. If the company succeeds, its earnings rise and the price of your share can increase. That's a capital gain. But ownership ties you to both success and failure. Prices can fall as well as rise. Buying stocks is an act of faith backed by research. Read reports and know the business. This is investing, not gambling. Think long-term and diversify your holdings. If a product becomes a hit, profits rise, demand for the stock rises, and your slice is worth more. You realize gains by selling your shares to another investor on the market. Recap. Stock equals sign ownership. You profit via price gains or dividends. Risk is real. Research matters. Next, where stocks come from and where they trade. Primary versus secondary markets. Chapter 2. Primary market versus secondary market. Title displayed. The primary market is where companies sell shares directly to investors for the first time. The IPO. Proceeds from the IPO go to the company to fund expansion, R&D, or pay debt. Often institutional investors are allocated shares first. Brokers may reserve some for retail clients. An IPO is a one-time event. Once issued, shares move to the secondary market for trading. Now let's look at the secondary market, where the daily action takes place. In the secondary market, investors trade shares among themselves. The company is not involved in each sale. Secondary markets provide liquidity, the ability to buy and sell without large price impact. Price discovery happens in the exchange order book. Every trade sets the last price. If primary is a dealership selling new cars, the secondary is the marketplace for used cars, many buyers and sellers. Primary market, investor money goes to the company. Secondary market, money flows from one investor to another. As a retail investor, you will spend most of your time in the secondary market. To access IPOs, check broker allocations. Sometimes retail clients do get allocations. Recap. Primary equals sign company raises money. Secondary equals sign investors trade among themselves. Both are essential. Up next, the forces that make prices move every second of the trading day. Chapter 3. How are prices set? Title on screen, now the core idea. At heart, price is a simple supply and demand tug-of-war between buyers and sellers. Demand increases when investors expect higher future profits, new products, or positive news. Supply increases when insiders sell, news turns bad, or investors take profits. Earnings surprises, product breakthroughs, or leadership changes all move demand quickly. Macro trends, rates, inflation, or a recession, shift demand across sectors. The visible order book shows bids and asks. The last trade becomes the quoted price. Low liquidity and wide spreads mean prices jump more on trades. High liquidity stabilizes price. Human emotions, greed and fear, amplify moves. FOMO chases rallies, panic fuels sell-offs. Analyst upgrades or news can trigger institutional flows that rapidly change demand. It's like an auction. More buyers pushing bids upward make sellers accept higher prices. Example. A surprise profit beat creates a rush to buy, raising price within minutes. When a price moves, ask, what changed in supply and demand? Company, economy, or emotion? Focus on fundamentals, earnings, innovation, management, and macro context to forecast demand. Volatility is normal. Build position sizing and risk rules to survive swings. Practice with paper trades, keep a checklist, and avoid emotional decisions. Recap: price equals sign result of supply and demand influenced by liquidity, news, and human psychology. Next, we meet the referees and the stadiums, SEBI and the major exchanges. Chapter 4: The role of SEBI and the stock exchanges. Title on screen. Exchanges like the NSE and BSE are the stadiums where buying and selling happens, electronically and transparently. The BSE is the veteran, established long ago. Its benchmark index is the Sensex. The NSE brought automated nationwide trading. Its index, Nifty 50, tracks the top 50 liquid stocks. Exchanges match buy and sell orders and publish prices in real time for everyone to see. They provide the infrastructure and ensure price transparency across the market. SEBI is India's market regulator, the referee who keeps the game fair. Its primary job is to protect investors from fraud and manipulation and to ensure market integrity. SEBI investigates insider trading, using trade surveillance to detect suspicious patterns. It mandates timely disclosure so all investors can access the same material information. SEBI regulates intermediaries, brokers, mutual funds, and advisors, ensuring they are registered and accountable. When rules are broken, SEBI has enforcement powers to sanction offenders and protect investors. Because of exchanges and SEBI, a retail investor sees the same prices and disclosures as big institutions. This trust is what enables millions to participate in the market with confidence. Recap: exchanges execute trades and publish prices. SEBI sets the rules and enforces them. To start, open a demat and trading account. Research companies you understand, paper trade, then start small. Discipline beats shortcuts. Quick recap: stocks equals sign ownership, primary versus secondary markets, prices equals sign supply and demand, SEBI and exchanges keep the market honest. Homework: pick 3 companies you know, read their annual reports, and paper trade a small position. This is a marathon, not a sprint. Start small, learn, and build discipline. If you found this useful, subscribe for the next module where we analyze a simple stock step by step. See you in the next lesson.